pleasure to be with you here this morning and talk about a range of things I think are currently impacting the market and more particularly may well be impacting into this later life segment of the market as we go through the next few years. If you just move on one, please, Les, then although it's not all about consumer duty, it's important, I think, that people understand the job that Amy does on their behalf. And I've been chief executive of Amy effectively since 2012, but also been looking after Amy since 2008, when we went into that last really bad credit cycle. But it's Amy's job to actually represent the commercial interests of firms to ensure that people can trade profitably in the future and make sure that we have the voice of the advisor in front of government regulators, civil servants, and other trade bodies in order to make sure that we build an industry that's fit for purpose of the future and works in hand with the customer in order to deliver the right outcomes from them. And whilst the regulators got some time to get there with consumer duty, that has certainly been one of the guiding mantras of Amy over the last decade in terms of trying to make sure that we did nothing that got in the way of ensuring we worked on the customer's behalf to deliver them great solutions. Let me just move on then. And look at the landscape that we are in today. And of course, most people are now looking down the barrel of a gun of what it will be probably the most significant budget in the last 15 years. Since the Tories arrived into government 14 years ago, and some of the budgets that happened in the early days of the Conservative Party, then they were pretty significant steps forward in terms of changing the landscape, particularly as Cameron wanted to drive us into probably what was seen as an age of austerity, but getting some fiscal control over an economy. And what we have now is a situation where it looks as though we're going to see similarly some quite hard actions taken, which are conflicting, I think, for a Labour Party that is very strongly trying to promise economic growth, as we saw from the commitments yesterday, which were, in fact, twice the size of the last summit that Sunak held on a similar basis, but were not very much lauded by the popular press yesterday. What we see is the conundrum of probably having to increase things like CGT in a world where they're trying to actually promote people to invest and make profit. And those two things don't quite gel in a world where you're actually trying to encourage firms to invest. And if your only route out is to increase CGT or increase tax on employment, i.e. through taxing national insurance contributions by employers, it's a disincentive for people to invest in the economy. And therefore, the big conundrum Labour are going to have walking into this budget is how they reconcile all of that in a world where actually, if they don't keep fiscal control, that will pressurise the Bank of England into keeping interest rates higher longer. And those two things are very interlinked. The next base rate decision is a week after the budget. And therefore, what we will see is a lot of head scratching going on between the interpretations that come out of that budget and of its budget responsibility, then driving into that next MPC meeting, where we already have clear split of opinion between Andrew Bailey giving indications of maybe cutting quicker, faster, against Andrew Pill, who's arguing that actually he wasn't sure that the last rate cut was actually justified. So you've got a contradiction in terms of all of this, and therefore we're going to see things moving. What you also have seen in the last few weeks, if those who've heard me speak in the last 6 to 8 weeks will have heard me talk about the disconnect between swap rates and the gilt yield curve. And what we have seen is that swap rates were getting a bit ahead of the market in terms of how quickly rates would come down. We're predicting almost 6 or 7 base rate cuts between now and the end of next year. What we've seen in the last few weeks is that reining back a little, and therefore the swap yield curve is coming back more into line with the gilt yield curve. And therefore, what we're seeing is that expectation of base rates are probably for just one more cut this year, and that could be November or December, and I favour December personally, and then 3 cuts next year. So we're at a rate probably of 4% at the end of 2025, as opposed to where we were predicting, which is 3.5%, and then 25 if you looked at where that swap curve was going. So reining back in terms of expectations in all of that. However, that runs in a world where funder and lender appetite is still as strong as ever. There is a lot of money still washing around the economy, despite the fact that we're now seeing quantitative tightening coming out of the Bank of England, as opposed to quantitative easing that we've had for the last decade, where there's still a lot of assets looking for return in order to fund all the things like pensions and other returns. Therefore, funder and lender appetite is still significant, and even mainstream lender appetite is strong because they need to get product through the door, because it is the arrangement fees that sit on those products as much as the interest rate that gives them income and profit to justify the large engines that they all run. And therefore, we're seeing a very competitive market moment, which will remain, but margins are very thin. I'll come back to that later on. What we also see is the fact that we've just had house price growth being confirmed as the strongest it's been for quite some time. And I've often said that house price growth has defied gravity. In fact, it's not just defied gravity, it's defied any form of economic expectation, in that we never mind what's happened over COVID and everything else. We were being dragged into rooms about 2.5 years ago as people were worrying about the advent of the cost of living crisis. And I was in a meeting at the FCA, which the bank and the PLA were at as well. And the worry was that we were going to see quite a significant shift in cost of living crisis. And the prediction at that point, that unemployment would go from around 4% to 8%. And it's once it trickles over 7% that you begin to get to the point where you would see significant repossessions in the marketplace. What was interesting was that we didn't get above 4.8% unemployment, and therefore the thing that might have happened to impact house prices did not occur. And therefore we saw leveling off, but we're now seeing house prices begin to tick up again because of all the things above that say money's becoming cheaper. There's lots of money out there washing around the system, and therefore there's a desire to keep house prices in a way that works positively for everybody. We move on then, talk a little bit about where our regulators, particularly around consumer duty. And one of the problems I have with consumer duty is that our regulator has been producing a lot of information around this post-fact. And I say that in terms of consumer duty is a significant number of rules and also guidance. But since they produced all of that and the industry started around the exercise, there have been a lot of speeches delivered by the FCA, a lot of DCO letters, which give a lot of colour, and also some webinars. The worst example of which was, they often worry me because they did one particular webinar recently, which lasted for an hour. And then when the online version of it was produced, it only ran for 48 minutes. And there were 12 minutes of it missing. And the interesting part was the 12 minutes were missing were the most salient parts of the webinar, when a couple of the FCA staff went a little bit rogue and said some things that perhaps they shouldn't have to give guidance to firms. And that was edited out of the final reel that was there for everybody to see. So it was only the 350 people who were there live that actually got the benefit of listening to what was said there. And that, I think, shows that we sometimes have a regulator who's not quite as helpful as they pretend to be. But what we now have is an expectation that people have done their first annual review at the end of July and reported. And the expectation is that that report will have for all firms some form of learning in it. The expectation of the regulators is that every firm should have found something to do better or different, no matter how perfect they may think they are. Nobody is that perfect. And therefore all firms should have things that they might want to change, amend, or improve on, because I talk about this sometimes about the sales curve, which is everybody markets themselves into certain marketplaces in terms of customer approaches and styles. And Leo and I talk quite a lot about this, particularly historically, around the fact that a lot of people who traditionally have dropped into the equity release market have come into a siloed approach, which means that the only product offering is equity release. And when you get a much more varied approach of full product sets, the outcomes are very different for customers. Now, the expectation of the regulator is that people will be thinking much more of the outcomes for customers. And if a customer comes into your sales channel and opts out at some point, so if that between the first contact and you doing the fact find, why do people opt out at that point? Between the fact find and an application submission, why do people opt out at that point, and what do you learn from them opting out at that point? From application to offer, some people fail. Why did they fail? What happened? What happened in that process? From offer to completion, some people don't get across the line. What are you doing to measure and learn from all of that that really gives the learning curve out of consumer duty that should be in people's annual reports about how do they change their marketing model to make sure more of the people that come at the start are the right people as opposed to the wrong people? Or are the people coming in the right people, but are you not giving them the broad enough solutions that should be there in a marketplace? And that is perhaps the learning that many firms have to get, is how do you change your offering, not just by your front-end marketing, but how do you make sure that even if you can't solve the problem of that customer, how do you give them to somebody who can? And that, I think, is the big learning that regulators are expecting in terms of good outcomes for consumers. So pleasure learning. And as Leon has already said, we have had some fairly aggressive market work from the regulator, which gave clear signals to the lifetime market that things needed to change because the evidence was that advice was not good enough. And a number of firms have been going through a process in order to do that. My concern is that there's only half the market and the other half are still living in either ignorance or denial. And therefore we have an issue still about how that is spread across everybody else. And I can say that at the moment in the other market, which is still causing them concern, is second charge market. And there is I call it enemy action. It's not enemy action, really. It's supervisory work from the regulator in order to look at that market. And there's a range of firms currently being looked at in terms of that. And we expect a report to come out on the second charge market by the end of this year. The only reason Lifetime is not still in the spotlight is because the market size when the FCA started looking at it was 6 billion growing to 10. Because it is now under 2 billion, the risk assessment of that is much lower. Because when you do any risk assessment, you're using 3 levels of measure. One is, what is the possible scale of loss? One is, what would the impact be on the number of customers involved? And also then, what is the scale of the market? And because the scale of the market is reduced significantly, not just by the number of people that are going through it, but also the average value of cases, the risk in terms of risk in profile has moved Lifetime a long way down the scale on the parameters that the FCA looks at as being a data-led regulator, something that they need to deal with today. But as the market grows back again and goes back through scale above 5 billion, I expect it to come back into focus quite significantly, and therefore the industry has an opportunity to clean house without being driven, but it's up to them as to how well they do that. If we move on then, Les, we're also now seeing a whole load of work linked to duty, which has only really been in place for 12 months across the whole of the market and for 24 months across the GI and protection market. So we have a call for input on simplification, i.e., and we have to go back to the regulator on this by the end of this month. Which of the rules would we like to see taken away because consumer duty is an overriding principle? It means everyone will behave themselves. Therefore, what of the tram lines or issues in the mortgage market and all markets could be removed from the rule book that we think could change? Now, some lenders are talking about the fact that we could perhaps simplify the ESIS or change the wordings of the ESIS to make it more clear. We could change the cheapest rule, perhaps, or we could change the way that APRs are calculated because they're not quite consistent with the way that customers work. There's a whole host of stuff around the fact that if you look through the rule book, consumer, customer, and client are defined differently in different parts of the rule book, which is crazy. And the financial promotion rules are inconsistent across the rule book between different product segments. So the consumer credit elements around financial promotions are very different from the mortgage rules around financial promotions. Therefore, they should be capable of being simplified and put into better codification. The other big one is vulnerability. The regulator, I think, is genuinely disappointed with where the industry has got to around vulnerability. It has written to UK Finance because they believe that they are the trade body which has purview over all of the lending markets, and asked them to do a piece of work to actually identify how we deal with vulnerability better so that the customer can tell us once, and that can be transmitted across all parties in the sector. I think the challenge we have around that is that at the moment, a number of compliance and legal specialists are very worried about data protection issues and ICO issues around that. I see that as a load of perverted nonsense, in that anything we do around vulnerability is in the customer's best interests. And as long as we have consent from the customer, then it doesn't matter where it flows across the sector, because we're actually doing our best to try to make accommodations to help them, not limit their ability to have access to finance. And as long as we work on the basis of how do we help, as opposed to hinder by using that information and data, we will have no problem with Information Commissioner's Office in terms of the use of that information and data. But we are still a long way from where we need to be, because both consumers and advisors are still concerned that by telling somebody about that vulnerability, it might change the lender's credit decision. And we need to get better and more comfort that we as an industry are working together hand in hand to work in the best interest of the consumer in all of this, as opposed to protecting ourselves from something that are in the wrong place. So much work still to be done in that, and I think this will run for at least another 18 months before we get to any point where we could feel comfortable around this. And of course, in the market where people are feeling vulnerable for some reason or another, and not everybody is vulnerable who enters this later life lending market, but there has to be a check, a sense check that says, is this person vulnerable or are they not? Or what accommodations we need to make, and what common sense accommodations we need to make. Because before we started, Leah and I were debating the fact that, do we genuinely need every 70-year-old to be accompanied or have a discussion with their children about what decisions they're making about their finances? No, they bloody don't, because I'm pretty close to 70, and I'm not going to have a discussion with my children about what I'm doing with my money, unless I decide to give them some, in which case it'll be a pleasant gift, not a pre-arranged plan. This stuff it needs to be thought through, because we're in a different dynamic now, where people have had a different earnings experience, a different life experience, and we have much more financially educated consumers at the back end now because of people like Martin Lewis, love him or hate him, who's done a lot to educate consumers in the way that the market works. But what we are seeing is a lot of work now coming out on a product oversight and governance, thematic review of general insurance and personal protection, and a multi-firm review of outcomes monitoring on how consumer duties worked in those markets. So there's lots of evidence now of the expectation from the regulator of how fair value should be assessed, how you should assess the good consumer outcome, and how far away the regulator thinks most firms are from doing this adequately in terms of fair value assessment, because most firms have started with the basis of what we charge is fair, how do we reverse engineer to justify that, as opposed to starting from scratch and building it all up from the bottom and saying, what is it is genuinely needed in this marketplace and what is the fair price and the fair delivery of customer expectations around that. Now, we also have a market study coming on pure protection. That's a 2-year process where this is done by competition economists to work out whether the amount of commission broadly that's flowing through the pure protection market is fair and whether the pricing that's done in the market works well. They're also concerned about both churn and also rebroking of insurance policies. Now, churn is bad, rebroking is good, because what we can have is people's health has not shifted and products have developed and therefore and pricing continues to come down. Therefore, somebody could get a better product by moving them to a new contract. Churn is merely where it reaches the end of the indemnity commission and we move them again to earn more commission. That is not good. We also have a situation where it's clearly in the regulator's purview that there are a whole range of non-advised insurers, insurance brokers, who are rebroking advised policies because they get cheaper cover, but the cover is not as good. And there's extreme concern that, in fact, those non-advised insurance firms are cancelling contracts and replacing them with similar but not as good contracts, but earning more money than those who go through advised contracts for doing so because they're delivering scale. Now, that therefore is clearly right in the crosshairs of a regulator who's concerned about consumer outcomes. And so that will be a fairly major piece of work that will run for at least the next 2 years and cast a shadow, I think, over the sector because it will limit investment and innovation in that marketplace until people see that come to the end. And therefore, that's why I always say that when the regulator is giving warning shots to a sector, they're better to work out how they deal with it themselves than wait for the regulator to come into view. Because when you get a study like this, it does cast a 2-year shadow over the sector. And therefore, anybody who's working in the lifetime mortgage market needs to think very carefully that they want to make sure they get their house in order themselves and are being tasked to do that by the regulator. The last part, just to talk about, is brokering lender fees. I can clear, if you think that the regulator is taking a possible hatchet to commission in the protection world, because it's clearly part of the study that's there on pure protection, that would then leave mortgages sitting right in the middle of a world where investments already have commission banned, protection commission could be under threat, and therefore that would leave mortgages right in the middle as an eyesore. And therefore, unless we protect commission in the pure protection world, then it would leave mortgages quite exposed around all of that. But of course, we also have a world where there's a grave disparity between the kind of broker fees and commissions being paid across this marketplace. If you're talking at a standard residential mortgage versus real versus lifetime, and making sure that all of the fair value assessments that are done around that hold water and are justified from the ground up, not from a retrofits perspective, then we have to make sure that we're on safe ground around all of that. And certainly volume override is something which is banned in the world, and anybody who thinks they can get away with that in a forward-looking world, I think, is stark stealing bonkers. But we'll see as we move forwards around that. I want to move forward from that, Les, if we can. So what else are our friends at the regulator trampling all over? Well, I'll start at the bottom. If anybody's thinking that they perhaps are feeling uncomfortable in working in the network they're working in, welcome to a new world where becoming authorised as directly authorised is a much more difficult proposition than it ever has been. And the type of documentation any firm now has to produce in order to get authorised on a direct authorisations basis, including business plans, cash flows, forward cash flows, and being able to demonstrate competence from a compliance and controls perspective, systems and controls perspective, is way higher and harder, and the bar is much higher than anything we've ever seen before. Therefore, anybody thinking of leaving a network will probably have to have a decent amount of scale and structure and background and experience before they would ever be able to approach this. We are seeing increasing supervisory action across a range of areas, and they're picking off sectors one by one, and I expect this to continue. And they've just issued, and they do this regularly, issue due seal letters to various sectors, which sets out their expectations of the market. We've just seen one come out to asset management. They're doing a fundamental review of acquisition of investment firms by other firms, and they're looking at, and I think they may at some point, and they're indicating unless firms begin to tidy up, what they will be looking at is that when a regulated entity is acquiring and the customers are not a regulated entity, they can't just leave that entity behind with no control. So the ability to just take the customers, leave the shell behind, and the principal then shut that down and leave any liability on the shoulders compensation scheme is something that they're very actively looking at. And I see this as something happening not only in this sector, because I see now for the first time great cooperation between the Ombudsman Service and the FCA in the area of claims management companies. So they've got rid of half the claims management companies that applied for authorization. They've not been authorized. Of the claims management companies that are now in existence, and there are only 270 of those 270, only 130 are active in actually pursuing claims. The others are just lead generators. So they don't actually do anything active in the marketplace. There are only 70 legal firms authorized by the SRA to do claims in the financial services sector. You can now make complaints about any CMC if you feel that they're not acting in a fair way with you as a firm. So that we're beginning to see a big sea change around how the regulator intervenes in markets and changes things. The other one that has been a concern here is the advice guidance boundary review, which they were looking to increase the scope of outside of investments. And this is really how do they get more people to take money out of cash and put into equities and bonds by making it probably easier for people to do their annual ISA allowance without full fat advice. Now, there was some debate as whether they wanted to bring that semi-skimmed advice into the mortgage market or the protection market, and we pulled them back away from that because we've made it very clear that we don't believe there's any instances where we need a third method of giving advice. It's either non-advised or it's advised. We don't need a space in the middle in these two markets because there's nothing going wrong. That means that we need a third type because all customers that want to be serviced are being serviced. The other part I just want to touch on is their great belief that the work we've done or they've done around affordability and stress testing in the mainstream mortgage market has been a great protector as we've gone through the increase in rates. And that is a fundamental where they will continue to drive their belief and the belief that sits at Financial Policy and Monetary Policy Committee, that the work that has been done in the UK on affordability and stress testing and evidencing income is a great driver of security. And also the fact that they believe that the rules as they're currently written, where you should always assess affordability before making a choice as to where somebody is placed from a product perspective, is a basic mantra that sits at the background of all the things that the regulator thinks and believes. And that is quite well instilled now across the senior levels of the FCA, who have lived through many of them all the way through their third or fourth financial crisis and seen the way that rules hardening. And this time, as we've gone through difficulties, there has not been the level of repossessions and stress that would have been expected in previous downturns. Okay, we move on from there. The last thing I just want to touch on in some detail is green, because there's a lot of talk about green and retrofit. And what's the best solution for consumers around all of this? Now, the challenge we have as a country is we've lost most of our immediate targets. There's a lack of a industry roadmap. We're waiting for the Department of Energy Security and Net Zero, Ed Miliband, to come up with his great plan. And until he does that, we're kind of in a kind of vortex of unknowns. We have within our sector the Green Mortgage Advice Initiative, which is a collaboration of lenders, brokers, surveyors, and Trustmark, who are trying to work together to work out how we facilitate things like this. And we have seen some good work from Connells and from Mortgage Advice Bureau recently, trying to build customer models where the customer can take advice on what retrofit they might need, what suppliers might work with them on that, and what might be the best route to finance. And let's be really clear, there should and will be multiple routes to finance around all of this, because whether it's unsecured and secured debt from second charge to regular mortgage to equity release, or even real, there should be a range of solutions considered for the customer. It should not be one option, because we need to work through a process that says, what is the best solution to this customer, particularly where many of the assets that might be bought, whether that is solar or a heat pump that will only last 10 to 15 years, why would you put that on a 30-year debt when the asset is going to destroy itself within 10 to 15 years? And therefore, perhaps thinking about the fact that the loan has to be over a different term to match the asset has to be part of what we think through in all of this. So appropriate funding solutions that are not this are part of the key. The last part of this is if people have got affordability at all to do this, then that should be the route, because if you're going to spend £20,000 and put it on a lifetime product over 30 years, that £20,000 eventually after 30 years at current interest rates is going to be £160,000 deduction to the estate against an asset that would probably save the customer the square root of not a lot. And that's part of the issue that sits at the background of all of this, where we've got perhaps a better interest for those people marketing these products to protect the value of the property rather than protecting the income sources of the consumer. And therefore, we've got a bit of a conundrum as to how we deal with all of that going forwards. So green is a difficult one. What we are seeing, however, is that government has committed verbally to the fact that the private rental sector should have all of their properties at EPC-ready or better by 2030. I cannot see that's possible, personally. If you've got a situation where we're going to achieve 150,000 property, sorry, 1.5 million properties in the lifetime of this Parliament, means we have to build 400,000 properties in 28 and 29. And we're also going to retrofit about 400,000 properties in both those 2 years as well. There are not enough builders, electricians, plumbers, anybody like that to do that amount of work, nor are the supply chains in terms of materials. And therefore, until we actually get some real government revolution about how all this will work practically, then I think we're staring into an abyss of planning blight. It's interesting that Starmer is very much talking about how we take all the planning issues away. That is only part of the matrix. I actually believe we probably need to go back to a bit of social re-engineering and saying to people that actually a degree in media studies is probably not worth very much in the long term if you walk out with £60,000 worth of student debt. But actually, if you go to college, learn to become a plumber or an electrician, you walk out of that with no debt and will probably earn more money over your lifetime than you would if you do a degree in media studies. And we need to think about whether that's a better solution for the UK in the short to medium term. But that's social engineering on a scale that we've not seen before. We move on then. What are my real worry needs? Well, I am aware that the FRE's Council is looking at new advice standards, and we have asked for the ability as AMA to share in contributing to the delivery of those, because we do believe that if those standards are going to stand the test of time, they need to be much wider than just equity release and think about the broader market. And this is AMA stepping across a bridge there. There's been a vast chasm and divide between ourselves and the council over the last decade. AMA has decided it would rather be inside the tent contributing than standing on the other side of the divide shouting at them. And therefore we have given the olive branch of saying we will help and support if you would let us in. I await the answer as to whether we will be allowed in, but we've made the formal request. Those standards, which will not probably be published until Q1 next year, have a range of work to be developed around them, but we are, and AMA makes the offer of being willing and supportive partners to make sure they work for the whole of the industry and sector in a way that is compatible with everybody. The challenge, I think, is everybody is talking about holistic advice, and holistic advice is immensely difficult because whenever firms of scale have tried to do what I call holistic advice in the past, they've fallen foul of some too many parts of it because holistic advice is immensely complex, and the regulator is immensely accommodating because the way it frames their rulebook allows people to segment their service offering and proposition and say, I only deal with this. And this is my specialism. If you want to talk about that, you need to talk to somebody else, but I will tell you about this bit. The bit that most people forget about is where the customer clearly needs something else, you should not carry on with what you are doing. You should pass it back to somebody else to deal with. That is clarity. That is in the rulebook. That is what consumer outcomes are all about. The situation where we have had for far too long, and I call them one-trick ponies who are siloed into one place, but only ever do that product without actually considering what else is available and passing the customer to somebody else, has to be over. Has to be over. It is not sustainable in a world of consumer duty where the consumer outcome is the only measure. The fact that you've ticked all the boxes to say it's suitable under my rules and our matrix does not work in the world of consumer outcomes. The customer has to have the outcome that's most suitable for them, not the world that fits best in your little narrow niche. And that therefore gets it to an interesting place. The last bit I'll talk about is innovation. Now, we are seeing innovation right across the landscape, not just in the later life market, but in other markets as well. So how we get people on the housing ladder at a younger age. We've seen all sorts of things coming out of Barclays and Skipton recently. We're really been pushing the boundaries and taking risks around what might be the public perception or the press perception of what they're trying to do. And Nationwide as well have done some clever stuff under the counter. And this is all good stuff. Where we come to for me here, and I make no apology for being quite direct about this, if I'm going to talk to somebody now about taking my pension out of a defined benefit scheme into some form of SIP or flexible arrangement, I'm only allowed to do that now within 2 years of when I'm going to start taking benefits by the regulator effectively. In fact, 6 months is probably where they'd rather do it, because their concern about all of that is that people are taking the money out far too early. And I took mine out a long time ago. I got before I got out before the drawbridge went up. I'm very happy I did, but it's not suitable for everybody. We have a situation where dying into certainty at an early point in life that then transmits you into one thing where you've given up a guaranteed benefit for something that is at risk and flexible. Where we have a flexible product that drops somebody into an interest-only type product that then converts to lifetime later, that cannot be on the basis of it has to convert at a certain date, or it has to be closer to the point at where it's going to convert than perhaps we see some of that product at the moment, because the advice risk in doing that is significant when I'm in a pensions market and I'm not allowed to do that, but in a mortgage market, I currently am. That is a risk that most firms, I think, should be thinking very carefully about. It's not to say it's not a good product development, and it's great to see it on the shelf, but we have to do it in a structure that works, and it should be a product that's there for a very limited number of people who understand and got certainty. And the problem we have is that perhaps not enough advisors understand enough to explain it in words that the customer understands. That gives me a concern about where we are around all of this. And finally, the need for advice has never been greater. People's lives are more complex, more difficult, and really, really horrible. And therefore, experts who can do this are really, really important. The biggest problem, of course, is that over the last few years, the cost of interest has moved rates and the ability to take money out more difficult. But the regulator has been really clear that as long as you've gone through full disclosure, full assessment, and done all the things that are right, you're probably, from an advice perspective, in a safe space. The biggest risk that we all run in all of this is that in the market where we have funders and lenders and advisors, there is not a total continuum of collaboration and cooperation, in my view. And therefore, we're still in a position here. And if I actually stand back and look at the industry as a whole, there are 3 markets where we have fundamental issues. The world of seconds, the world of lifetime, and the world of protection. There's one unique feature between these. The actual product definitions are set not by the lender, but they're set by a third party. In the world of seconds, mainly a funder. In the world of lifetime, mainly a funder. In the world of insurance, it's set by the reinsurer. And therefore, the product manufacturer is on the hook, and the advisor on the hook is actually dictated to by a third party who virtually sits outside the reg culture. And we need to recognize in the industry that we need to change that landscape and take better control. And consumer duty is actually about reinvoking that control. However, there's pressure on margins everywhere. Lender margins, advisor margins, customer margins are all under extreme pressure. But what everybody needs to stand back and think about is, what is fair value and a fair and good outcome? Is a good outcome in the world of standard resi, I've got the mortgage and I get the house? Is it I've got a mortgage, I've got the house, and actually I've got buildings contents cover? Or is it actually I've got the house and I've got full insurance protection around it, life, critical illness, and income protection? And if I've not got that, why not? And in the world of later life, is it making sure that we give the best solution that gives the best outcome for the longest possible time, using all of affordability in a way that makes sure that the possible cost to the estate at the end of it is the minimum it can be, and therefore the best is delivered in terms of the customer objectives and the clarity of what the customer objective is. If the objective is getting rid of their wealth to their children, that's fine. If the objective is I want the best lifestyle possible and I don't care what the cost is, that's fine. But getting that clearly documented with the customer is the key to all of this. And I'll leave you with these thoughts that say, effectively, our future is in our own hands. The need for advice and the need for quality products has never been greater. It's been great to have a chat with you today, and I would commend, as I do, lenders like LiveMore and Hodge, because I always think you should talk about somebody else as well to give comparison, who provide comprehensive product sets that are different to everybody else and give people great options around what's there. There are also a load of building societies out there to lend to age 100 that most people don't know about, and therefore knowing what's out there and being aware is really, really important. Thank you.